I'm Ric Edelman. Let's talk about your kids, from the best way to hire a nanny to the odds that your 6-year-old will earn millions as a pro athlete. Here's a hint. The owner of the Arizona Diamondbacks says keep adding to that college fund. Plus, how much you can expect from Social Security, the reality behind private equity funds, and how to be a winner in real estate. All that and much more straight ahead on The Truth About Money.
Best-selling author and founder of one of the nation's largest financial planning firms, Ric Edelman.
Wouldn't it be great to have a live-in nanny? Well, if you've got 2 or more kids in preschool, the cost might actually be within your reach. That's what my colleague, financial advisor Anderson Wozni, recently found out. Here's the story he filed.
Everybody has these prototypes in their mind, whether it's Mary Poppins or Alice from the Brady Bunch. They want Mr. Belvedere, their whole list of kind of iconic figures that are not for real. But I do think what people want is somebody who's going to be really devoted to their children. Nannies are not domestic, they're not housekeepers, but they are responsible to do anything that pertains to the children.
So basically picking up after the kids.
Right.
So they're not going to go out and scrub toilets and do things like that?
Absolutely not.
Cherry, that was my favorite.
If you have a permanent nanny in your house and your child is sick, the likelihood is that nanny is going to stay and help and call the parent or call the physician. A nanny also knows your child very well, and she can sense that this child is starting to get sick. I can tell there's something going on here. So there's a real advantage.
If I'm hiring a nanny, how much can I expect to pay?
The average rate is somewhere between $15 to $20 an hour. So if someone's going to work 40 hours a week, annually that's about $41,600 a year.
Aside from the pay, what other benefits do nannies receive? I have my health insurance through work, and I don't think they'd allow me to put my nanny on my health insurance.
No, they would not. And people have tried this, but that doesn't work. The nanny's responsible for finding her own policy, and what we would hope that the family would either pay half of it or all of it. But they are not responsible for finding the actual policy for their caregiver.
I suppose I can't put her, if I own a business, on the payroll and call it okay.
It's not okay. Sorry to report, not okay. We have a lot of people who will call and say, listen, I have, this nanny's going to get full benefits. She's going to get dental, she's going to get health, she's going to get everything, a 401k, all through my business. Unfortunately, that's not legal to do.
Is it my responsibility if I hire the nanny to then file the taxes? And
yes.
It is.
It is. It is illegal not to pay taxes. So paying them off the books is illegal. There are a couple services who really focus totally on domestic tax services.
So how do you go about the process of vetting a nanny?
Meet every caregiver in person. We call their references. 3 of us interview every nanny who comes through here. We try to get a sense, is this somebody we would want in our house? Is she good? What's her personality like? What's her experience like? We look at their track record, their work chronology. We also do background checks on every caregiver.
Can I just go online to look for a nanny?
Parents are seeing page after page of postings of nannies touting their skill set, but there's no one really vetting to say whether any of it is true.
Anderson, welcome back to the show.
Thank you.
It seems from the way she was describing it that nannies aren't just for the richest Americans anymore.
No, they're actually not, and that was the thing that was amazing to me was the cost of it relative to what a lot of our clients pay for normal daycare services after school. And when you factor in the hassle factor of if your child's sick, they don't go to daycare, which means you have to take off from work, you have to take them to the doctor. Well, if you've got a nanny that's at your home, chances are if it's a sniffles, she can stay home.
Or I would assume even if the plumber has to stop by, there's someone there, an adult in the house.
There's someone there who can receive packages, who in certain cases can do some light shopping. So there's a benefit to it beyond just the taking care of the child, although that is their primary duty.
So it would seem, if we're talking about, she said, an average salary around $41,000, when you add in taxes you'll have to pay, kicking in for their health insurance, perhaps other benefits, you're probably talking $50,000, $60,000, $70,000 all in?
If you're talking about a full-time live-in nanny, yeah, you are talking about something in that range. But it may be that you're hiring a part-time nanny for 3 or 4 hours a day where your costs are going to be dramatically lower. Or in certain cases, maybe you're hiring for a season. You've got a nanny that's going to be with the kids during the summer.
And what kind of cost are they going to add on as an agency helping you find this person?
Well, they're charging a fee effectively the way most headhunters charge fees. So it's a fee, it's a percentage of their expected salaries for the first year is what they're charging.
So add another 20 or 30% on top of that.
Exactly.
So it's definitely something I think people should look into, and odds are it would never occur to most folks to consider this.
No, that's the thing. It's not going to occur to you until you sit down and you start to do the math and you go, wow, I'm spending thousands of dollars on daycare. Why not just shift that cost to a nanny?
Anderson, thanks very much.
Thank you.
What is the approximate maximum annual income a worker and a spouse who retired in 2010 can expect from Social Security? Is it $24,000, $28,000, $44,000, or $54,000? The answer is coming up, so stick around.
At a recent conference, investment advisors were asked just one question. What was your biggest mistake?
To buy an individual security. An individual security can go bankrupt.
As an advisor, the biggest mistake I've ever made is not listening closely to the thing that is the most important to that client.
Probably not working enough during my college years and not saving enough money during that time, as such, not starting early enough on my own retirement.
I bet you could ask my husband what my biggest mistake was and he'd be happy to tell you.
So, how much do you think you'll be getting from Social Security? The correct answer is that a couple who retired in 2010 can expect a maximum income of $28,000 from Social Security.
Chuck, he's first up, calling from Centerville. How are you, Chuck?
I'm doing great.
How can we help you?
Thanks for taking my call.
Our pleasure. How can we help?
I got a question. I've set up a inherited IRA for my mother's estate last year, and this is the first year that I'm facing the RMD requirement.
Okay.
And I'm familiar with the table and how much I need to take out. My question is it's all in stock. Is there a way, or what's the best way to take out the minimum required, and can I take it out in kind and put it into another account? I don't really need the money, but I need to make sure that whatever I distribute, that I've got the tax burden accounted for properly.
Well, first of all, Chuck, it doesn't matter that this account holds stock. In other words, the asset doesn't matter in an IRA. In an IRA, the only thing that matters is the value of the account. What it holds is irrelevant. We need to go back to December 31 of the prior year to determine for IRS purposes the account value, and then look at the IRS tables to determine the percentage that has to be withdrawn, which is based on the age of the individual involved, and then go from there.
Yeah, yeah,
so
Chuck.
the basis would be year
No, Chuck. There is no basis.
The basis is zero.
Right. There is no basis. It's an IRA account. That's my point. It doesn't matter what the asset is. There is no basis. If it's in an IRA account, you have to pay taxes on the value of that account, period.
Right, and basis was probably the wrong terminology. It's the account value.
Correct.
Right.
That's what I use to calculate
Correct.
the RMD.
Correct.
Okay, and then once again, so I cash the stock that is needed to satisfy that requirement.
Correct. You have to liquidate enough of the asset to withdraw it from the account. Correct.
Okay, I can't just transfer those shares in kind to another account?
Well, Chuck, you might be able to do that if you have two accounts with the same broker, but from a tax perspective, if they will allow that, the impact won't be any different.
Right.
But you might save a very small, I guess, commission on both ends.
Yeah, in other words,
you
instead of liquidating $1,000 worth of stock, you might transfer $1,000 worth of shares to a non-IRA account.
Correct.
It'll accomplish the same thing.
Now, the question that immediately comes to mind, and I'm going to confess I don't know the answer to this, what is the basis of that stock if he then does that?
It's the value as of the date of the transfer.
Okay, so the date of the transfer, because he's paying tax on the entire amount.
Right.
But then he'd have to hold it for 1 year for it to be long-term?
Correct.
Yeah. Okay.
So it would be treated as a purchase. So it doesn't matter, other than, as Brandon pointed out, other than avoiding the commissions on selling it and rebuying it, it's irrelevant. Doesn't make any difference.
I think that's negligible. I just didn't
Of course, there is another reason, and that is to avoid being out of the market for a period of time. Although if it's at one institution, they'll do it within a day, and it's no big deal. So I don't think it matters a whole lot at the end of the day, Chuck.
Okay, and the appreciation for this year and stock value and dividends and all that, I'll just
doesn't matter.
Reset that for next year.
Correct. Right. Doesn't make any difference.
Okay.
All right.
Great.
Glad we could help.
I don't want to get fired, though. It's the worst. Bosses make getting fired sound like the best thing to happen to you since the Emancipation Proclamation. They lean in all lovingly. We don't think you're happy here. We're gonna have to let you go. Fly, little bird.
Hi, Rick. I read an article that said that the return from private equity funds was so much greater than the average return on ETFs and mutual funds. So I'm kind of curious as to, because they were managed, I guess, by hedge fund managers. I'm not sure. There was a lot of kind of hocus pocus, and I'd like you to shed a little light on what are they, who buys them, can regular retail investors buy them, and if so, should they?
Great question. We hear a lot about exotic investments. A lot of people are looking for alternatives because they're very dissatisfied with the low interest rates in bank accounts, dissatisfied with the losses they've incurred in their other investments, and there must be something better out there. The grass has to be greener somewhere, and that has raised this whole cottage industry on Wall Street that are called alternatives. And private equity funds are one of those newfangled kinds of products that are available out there that give people the ability to invest in an alternative way from the past. The definition is fuzzy because it's not a legal term, it's just a colloquial phrase that Wall Street folks use. Private equity refers to people who privately pool their equity into a fund, hire a manager who then makes investments for them. Most of the investments this manager makes are in companies that are not publicly traded. A mutual fund is going to buy stocks of publicly traded companies. A mutual fund is going to own IBM and Microsoft and companies like that. A private equity fund is going to invest in companies that are not yet publicly traded. Small, new companies, often in the biotech world or the high-tech world or the computer industry, that are young companies, fast-growing, looking for seed capital, investor capital, in an effort to grow big where they can eventually go public one day. So these are very high-risk ventures. And they typically are available only to very wealthy people. These funds, because of their differences in regulation, sometimes, frankly, relatively unregulated, they're available only to accredited investors, people who invest at least $1 million, who have more than $1 million to invest in these kinds of assets. Institutional investors are among the biggest folks, pension funds, endowments, and things of that sort. If you, as a retail investor, have opportunity to invest in something like this, should you? Only after you've invested everywhere else. In other words, picture investing like a pyramid. At the base of the pyramid, that's where you have most of the bricks. Most of your action, most of your energy, most of your assets are at the base of the pyramid. Government bonds, CDs, bank accounts at the base of the pyramid. As you climb the pyramid, you get riskier and riskier. The higher you go, the scarier it gets. By the time you're at the top of the pyramid, there's a tiny little cone there. So it might be 1 or 2% of your assets, 5% of your assets. If that went worthless, so what? It's only 5%. That's where the private equity fund is. It's all the way up there. Most ordinary Americans are down at the bottom 2 or 3 levels. We don't have enough wealth to play up there. So don't do that. You know what bothers me is when I see someone, they show me their investment portfolio and I look at their pyramid and they've got a pyramid and it's upside down. All their money is in this risky stuff and they don't have anything safe. And that's what's really scary because those kinds of upside down pyramids topple over really easily. Okay. So private equity funds are not for most of us.
Okay, thank you.
Your financial obligations change when you get married. That is just true. And my wedding day, my dad actually pulled me aside and he was like, you know, you have your own family now. You have some responsibilities. You need to write a will. And I think what my dad, I see what he's saying, but I also don't think he's understanding that I will never die, just ever.
Hey, Rick, I've got a question. What's the best way to go about buying a home as a first-time buyer?
Home ownership is the American dream. Unfortunately, it can quickly turn into a nightmare if you bought that house too soon, or worse, bought a house you discover you can't afford. On our website at thetruthaboutmoneytv.com, I have my 10-question quiz to help you figure out if you're ready to buy a home. Here, I'm going to give you 2 of the most important points. Number 1, make sure that the home you're planning to buy is a home you're planning to keep for at least 7 to 10 years. It takes a long time to really make this a profitable investment strategy. Think about it. You've got to come up with a lot of money as a down payment. You're going to be incurring lots of costs as a homeowner that you'll never incur as a tenant, meaning decorations, let alone upkeep, maintenance, repairs, property taxes, and of course, the payment on the mortgage itself. So you're going to incur a lot of cash out of pocket that renters never incur, and it takes at least 7 to 10 years for all of it to really make sense. And that leads us to step number 2. You cannot buy a home today based on your lifestyle today. In other words, if you're going to live in this home for 7 to 10 years, will the home meet your lifestyle needs for years to come? If you're not yet married, if you don't yet have children, but you think both are in your future, you need to make sure the home you buy today is one that will accommodate your future life. Ditto for your career. If you're thinking of relocating because of your job, well, that's not conducive if you're going to buy a house right now. So, those 2 points you have to overcome, and the other 8 are available on our website at thetruthaboutmoneytv.com.
How would you describe gold? Is it a hedge against inflation? A hedge against a falling dollar? A hedge against rising taxes? Or a speculative investment? We'll be back with the answer in just a few moments.
Convinced that your kid has a chance to make it in the major leagues? Well, get ready for a reality check from a guy who hires those kids. Ken Kendrick, owner of the Arizona Diamondbacks. We talked with him at Salt River Fields, the team's spring training facility in Scottsdale, Arizona. So you didn't grow up in the baseball world?
Oh no, I'm a Johnny-come-lately, as is our franchise. I mean, the baseball business in Arizona is very new. We didn't begin to play here until 1998.
So was it always a passion to become a sports owner?
You know, it's a Walter Mitty dream, I think, for a lot of us. You know, I grew up in small-town America in West Virginia, and was an avid baseball fan. That was the thing that my dad and I shared. We loved baseball together. He brought me up in the sport, and so you know, I always wanted to be a player, as I think a lot of young boys do, and of course didn't have the talent. And in later years, after having come to Arizona, there was the opportunity to start a franchise, and so I joined in when the franchise began.
There are a lot of parents trying very hard to save for college. And many of them are assuming that their very talented 8-year-olds are going to win an athletic scholarship. And with that, get a full ride to college and maybe even one day make it to the pros. How realistic is that attitude?
Well, I think the statistics would tell you that it's very, very difficult to make it to the point in baseball where you're earning a living. One in 300,000 kids who play Little League Baseball actually become a professional player, and then a very small percentage of professional players become major leaguers. And we have, at any one time on our major league roster, 25 players, but we have more than 200 players that are playing on our minor league teams.
What would you say is the average salary of a major league team player?
Major league players, the minimum salary is near $500,000, and the average salary is in the several millions.
But there are another several hundred in the professional level, but in the minor leagues, what are their salaries?
Well, their salaries are more like everyday working person's salary at various occupations. In fact, many of them are paid very modestly. I mean, it's really
meaning 10 or 20 or 30 grand.
That's right.
And yet they're considered professionals, and they're among the 1 out of 300,000 who have made it to professional ball clubs.
That's very correct.
So that's a real strong message for people who are thinking that they aspire to a career in professional baseball.
That's right, but you don't. I think life is. All our lives are built on dreams, and you want to be realistic about your dreams, but you wouldn't want kids to not think there was ever an opportunity for them. And we support Little League Baseball, and we build fields, and we encourage kids to play the game, and most of them will turn into being fans more than they will be professional players.
Which, of course, helps fuel the support of the sport as well.
Absolutely.
Ball players at the major league level make an awful lot of money. Millions of dollars routinely. There have been lots of stories of ball players, once they leave the sport and retire, that they go broke pretty quickly, if only because of poor money management or just outright scams and frauds that they become victims to. Does the team spend any effort trying to teach these young players how to manage the money that they've been making?
Yeah, there's quite an effort put into giving counseling to the players and support to them and teaching them about managing their money and taking care of their money. And actually, baseball has a much, much better record of our players doing well in later life than, again, the other sports. Because, as I stated earlier, when you're a minor leaguer, and almost all players go through a period of minor league play, sometimes as long as 5 or 6 years, almost always 3 or 4 years, before they become major leaguers, they live a real life. They live in smaller cities. They earn a regular wage. They travel on buses. They stay in less expensive housing. So they understand about real life.
So it's really interesting. The farm system of money is actually helping them to hone that side of the craft as well as their on-field play.
Yeah, we think so.
Ken, thanks so much.
Yeah, my pleasure.
This could surprise a lot of people, but in fact, gold is not a hedge against inflation or falling dollar or rising taxes. Gold is a speculative investment.
Before we go, some thoughts on today's show. We talked a lot about unrealistic dreams, that your kid will earn millions in the major leagues, that you'll receive more than $28,000 a year from Social Security, or that your live-in nanny will work out as perfectly as those in a 60s TV sitcom. It's always tough when dreams get shattered, but it's a mistake to go through life without a dream. You need a vision of a bright future. That's what keeps us going, willing to make the sacrifices that will pay off. But make sure that your dreams are realistic, seemingly out of reach, but ultimately, truly within your grasp. That's the truth about money. I'll see you next week.